Let's begin with our investment scenario. We're forecasting a major external shock, something like a war or a global pandemic, that sends the Australian economy into a deep downward turn. Consumer confidence collapses, unemployment spikes, disposable income falls sharply, and suddenly, households and businesses can't repay their loans. This then triggers a wave of defaults, credit losses mount, and pressure piles onto major banks, especially the Commonwealth Bank of Australia. Because when fear takes over, investors don't run to banks, they run to gold. And we're not just predicting the next crisis, we're trading it. Now let's walk through the macro trends of our top-down research. In crisis-induced recession, loan defaults rise sharply, particularly in housing and small business loans. Household savings and consumption drops, and investors shift their capital into safe haven, assets being most notably gold. We've seen this exact pattern before in 2008 during the global financial crisis and again in 2020 at the peak of COVID panic. And history just doesn't just rhyme, it repeats. And there's a strong pivot to gold in every crisis. Reputers put it best, gold is consistently used as a hedge in times of macroeconomic stress, and the RBA just recently warned that Australia's banks face increasing loan stress as wage growth lags inflation and property values decline. This puts CBA in the firing line. Even the most stable banks buckle when liquidity dries up and defaults rise. Now let's turn over to our bottom up research. CBA is overvalued, overexposed, and overly reliant on economic stability. It's facing rising provisions for bad debts, and its earnings are vulnerable to a slowdown. And our model values CBA at just $47.14, compared to a current market price of $172.40. It's Australia's biggest bank, but right now it's also our biggest risk. By contrast, Northern Star Resources is well positioned. It's a low debt, high margin gold producer with a strong cash flow and upside from gold's rising price, especially in times of volatility. NSC becomes value. Our valuation puts NSC at $26.14, well above its current price of $18.40. Gold doesn't panic, people do. That's why we're back in NSD. So what's the play? We're shorting fear and we're buying security. CBA falls, NST rises, and we're positioned for both. And this is how you turn panic into profit. I'll now hand you over to my colleague Lockie.
Thanks, Jack. In times of global crisis, investor behavior shifts dramatically. Trust in financial institutions erodes, markets become volatile, and there's a strong flight to safety. Gold is viewed as a store of value, a hedge against inflation, and a reliable asset when economies falter. This surge in demand for gold directly benefits gold producers such as Northern Star Resources. NST has strong leverage to the gold price. As gold rises, its revenue and profits grow dramatically thanks to its efficient cost structure. What further sets them apart is its financial strength. It carries low debt and generates cash flow, which allows them to maintain operations and even reinvest during downturns when other companies are forced to scale back. Because NST operates in a sector that often moves counter to the broader market, it acts as a natural hedge in an investment portfolio. When traditional equities are falling, NST often rises, offering diversification and protection. Northern Star Resources presents a compelling investment opportunity, supported by strong free cash flow growth, a low cost of equity, and significant upside potential. Our DCF analysis, based on conservative assumptions, implies a fair value of $25.11 per share, 36.5% above the current market price. With declining capex and rising cash generation, NST is well positioned to deliver long-term value, particularly in uncertain economic environments. It isn't just a safe haven, it's a strategic asset with the potential to outperform and therefore is our buy recommendation. And next is Mitchell with our sell recommendation.
We issue a sell recommendation on Commonwealth Bank, driven by deteriorating macroeconomic conditions and stress within the banking sector. CBA is particularly vulnerable to a credit shock due to its high exposure to the Australian housing market. With mortgage stress intensifying amid elevated interest rates and cost of living pressures, the bank is likely to face rising defaults and an increase in bad debts. This risk is amplified by CBA's dominant home loan portfolio, which leaves little room to diversify credit risk in a downturn. Net interest margins, which are a key profitability driver, are under pressure. The RBA's policy stance of holding rates high for longer continues to squeeze margins as deposit costs rise faster than loan yields. Coupled with this, regulatory risk has increased. In the wake of the crisis, APRA may tighten capital requirements, adding further strain to banks' balance sheets. There is also growing concern over liquidity. CBA, like other major banks, relies on wholesale funding markets, so a potential liquidity crunch could significantly constrain lending capacity. From a valuation perspective, CBA appears expensive relative to peers and its own history. Both its price to earnings and price to book ratios are above long-term medians, suggesting it is overvalued in a high-risk environment. From a valuation standpoint, CBA appears materially overvalued. Our DCF model estimates a fair value of just $47.14 versus a current share price of $161, implying a downside of over 70%. Given a combination of fundamental risk factors and substantial overvaluation, we recommend selling CBA and reallocating into more defensively priced opportunities. CBA may be a fortress, but even a fortress can fall under pressure.